Welcome to another episode of the Bank Free Blueprint. And today I have with me Jessica Barr. Welcome, Jessica.
Hello, thank you.
Yes, absolutely. It's really cool to have you on the podcast. We have known each other now for probably 5 years, 5 or 6 years, probably.
Yeah, 6, I think.
Yeah, and we've been doing a lot of business together. You have a company where you do the lending. You've also got a company that you're involved with that does the servicing for lenders that do projects. So you're with Good Steward Capital Management. You've been in real estate for almost 10 years now, maybe?
A little over 10 years.
Yeah. And you've done commercial, residential, renovations, and I'm just telling you the ones that I know of, and then you can add in. But residential renovation, even commercial, like multifamily renovations.
Yes.
Have you done some new construction or not? Not at this point yet.
We have not done any new construction.
Okay, cool. Well, welcome. I really appreciate you taking the time here, and looking forward to this interview because you are one that is known for being able to really manage risks. And
Thanks.
And you're really good at, I know that you and I have had a lot of discussions about setting criteria, getting the right criteria for your lending business, or maybe it's and we're going to be talking to investors who might be just starting out, or it might be passive investors who have money that they want to put with the other active investors that are doing the deals.
Mm-hmm.
So from that context of both sides. But regardless, both sides really need to have an idea of what they want to use for underwriting criteria, right?
Absolutely.
So maybe could you just walk us through a little bit, start out by what we mean by underwriting criteria, and then what was your process when you initially started? And then we'll walk through the steps as first it's setting up the criteria, then it's making sure we're following them and the checklist and all that. So would you like to share a bit about how you got, maybe even just a little bit about your background as well, and then talk a bit about how you set up your criteria?
Okay, sure. So if you consider the fact that I've been doing real estate for a little over 10 years, that has me starting right before the crash of 2008. And that was really my training ground. I got into real estate doing everything wrong because everybody was doing everything wrong at the time,
right.
Thinking the market would go up forever, which is a dumb thing to think. And I got caught up in all of that hype. And even the mentors I had hired to train me were really encouraging some of those same mistakes. And so my beginnings was really it all fell apart. I filed bankruptcy and I started again. But I started again with this understanding of things can go wrong and they will go wrong. Let's figure out what could possibly go wrong and make sure we're ready for it. And so that really is the basis of underwriting criteria. There's two sides of underwriting criteria. One is, what do you want to be doing so that you're only investing in or lending on the type of asset that you want to invest in or lend on, instead of being caught up in any good deal that comes your way. Mm-hmm. The other side of underwriting criteria is making sure that you've covered all the downsides as much as possible so that when things go wrong, because they will,
yes,
that you don't take a haircut.
Right. And so did you have a template or anything to go off of, or how did you trigger? I know that with all your experience, you probably had a lot of things that you had already realized beforehand, but with underwriting criteria, that's what sets us up to really be able to do our due diligence later on. We set our criteria, we go out and find a project that looks like it will fit the criteria. We go as far as we can with that, but it's all only done with the underwriting kind of in a parallel path. And so the underwriting is what proves that your criteria are being met. And so with that, how did you get that? Let's say that we're talking with for any of the listeners that are looking to create that underwriting checklist.
Okay.
What advice would you give?
Sure. So the underwriting checklist really started with the basics of what are we going to do? And at that time, we were doing lending on single family, either already renovated properties or fix and flip properties, and we were lending on them. So our underwriting criteria included things like it's going to be a 1 to 4 unit residential home. It's going to have a maximum LTV that will lend of, in our case, it was 65%. It had to be not in a war zone, which is a really vague criteria. But hey, it's at least a good place to start. You then need to go back and define, okay, what's a war zone? And we had a price
on
range.
that point, one thing, I was sorry to interrupt you on the war zone thing of it. Although it's vague, it still is a criteria that when you're looking at it, at least you make sure that you've aimed for that target. And then if
Yes.
some other reason that it could make sense to do it, at least it's been, that decision has been made on the basis of that checklist.
I totally agree. It's way better to have a vague criteria than no criteria at all.
Yeah.
Because at least with a vague criteria, you're thinking about it instead of ignoring that aspect. So even if you're making your criteria for your underwriting checklist and you don't know what to put on there, having something vague, even if it's vague, like I have to feel good about it. Okay, well that's something. So it's better to have something than nothing. Definitely.
Yeah.
Yes, and you know what a war zone is differs to everybody because it's really what you're comfortable with. So, and so there's definitely a gut feeling about doing these things too.
So there's different areas, like there's location would be one broad area, pricing would be another broad area, type of, let's say it's renovation, type of renovation. Is it going to be a light renovation, a moderate renovation, or an extensive or heavy renovation? It would be things like, so we've got location, we've got pricing, we've got strategies. Is it a buy and hold? Is it a fix and flip? Is it a combination of the two?
Right. And how long of a loan term you want, or if you're buying a property, how long you intend to stay in it, and then looking at the exit strategies and can you get out in the time frame you want,
right?
Or are you going to get stuck in that longer? It's one thing to write a 6-month loan, but if you really know in the back of your head it's going to be a 2-year loan, don't kid yourself by saying, but we only wrote it for 6 months, right?
Right.
So you got to make sure you really can get out in the time frame that you're projecting to.
And did you use a template, or because you've got a lot of years of experience, I'm assuming that you must have some sort of a list or something that you go off of. What would you recommend? What's a process you'd recommend for a list?
Yeah, we created our own template over time. And every time something would go wrong, we would add some new criteria to our list.
That's exactly how we did it too.
Yeah. So it's a pretty long list now. It started off pretty short. Now it's pretty long. And definitely fleshing out some of those things. Like, I mean, even you mentioned, okay, if you're lending on or doing a rehab, is it moderate, light, heavy? Well, what does that mean, right? Some people look at that as a percentage of the total cost into rehab. Some of it look at the type of work that has to be done regardless of the cost on it. So being able to really write out what you're comfortable with.
When you started, did you start with multifamily? Did you start with single family? When you started on actually in the lending side of the equation, where did you start?
I started with single family. It was the right time in the market to be in single family, and it's also a much lower threshold to entry. So you can, whether you're buying or lending, you can get in with a lot lower dollar amount.
One of the criteria is out of the area. If we're lending outside of our area, what is your criteria on that? Do you lend outside of your area? Do you try to is there a certain radius that you try to stay within from your location? By the way, you're in Tucson.
I'm in Tucson, Arizona, right? When we started lending, we would go within 100 miles because we could drive there. And it is definitely easier to manage things when you can drive there yourself and make sure that progress is being made. The market here dried up, and we were really stuck with an option of stop lending or go elsewhere. And so we decided to go elsewhere, and it requires a lot more due diligence and team building, because you're really, unless you want to fly out there every week, you're relying on somebody else to help you make sure things are progressing.
Mm-hmm.
And you definitely run into problems where we thought we had a strong team and they fell through.
Yeah.
We're stuck rebuilding the team. So there's definitely challenges to it.
One of the things that I would say has been my biggest learning curve has been teams and the ability of the contractors and developers, and if it's a borrower-lender relationship, the performance of the borrower from a project perspective more than anything. Over the years, I know we've funded a lot of projects, and to this date, I would say we've never funded a bad project, but we certainly have funded a couple of doozy developers early on before, luckily it was early on when things were a lot lower compared to the scale we're at right now.
Right.
But would you agree that teams and the ability to implement the strategy would be a high priority?
Yes, absolutely. I mean, whether it's local or on the other side of the country or the other side of the world, for that matter, the borrower is key. I mean, if you really want to be even semi-passive in this business, you have to have a good borrower, because you're really counting on them to do all of the active work and make money for you. If you have to even somewhat manage that borrower, then you're going to lose the passiveness that you wanted.
Yeah.
So yeah, I agree.
Right, and just for clarification, sometimes it's a borrower-lender relationship. So even if a passive investor, somebody with money, is teaming up with somebody who has a deal and who's going to be the facilitator or the general contractor or the project coordinator, that would apply the exact same as if it's a borrower-lender relationship, because it's that person that's wearing, or that person or those people that are doing that part of the business and wearing the hat of the facilitator, contractor, developer, whatever it may be.
Right. So, yes. Being able to rely on your team to do their job so that you can just do the money.
Yes, exactly. What, when you started out, or maybe when you started out earlier on, can you think of one or two things that you wish you had known at that time? Like, for instance, again, if there are people that are listening that are getting started, what bit of advice would you give them based on what you've known?
Well, it
sounds like Judah is awake by the way.
Let me hang on. I'll introduce him to everyone.
Sweet, excellent. Hey.
This is my baby, and this is why I keep looking down.
All right.
He's trying to nap here in my arms.
Well, we'll try to lull him to sleep then with our discussion.
Yeah.
Right? No, actually we won't. We'll keep it up and lively. So
I guess probably the first thing that comes to mind is related to the projects and the underwriting, is that you can't take an appraisal at face value. Just because the appraisal says that a property is worth $200,000 does not mean that property will sell for $200,000.
Yeah.
And there's a lot of things, like you made the comment that you've never funded a bad project. I have. Now, I mean, I wish the borrower had been smart enough to know, but I also wasn't smart enough to know. And some of those things, like you said, location, if the property is on a busy street, it can appraise for whatever the property a street over appraises for, but that doesn't mean anyone wants to buy it. And so you have to take a discount to be able to move that property because of its location.
So maybe if you
have to look at what's your neighborhood and what's right around that house, not just the house itself.
In the example you're talking about, are you able to share a little bit of how that difference in value was not reflected in the appraisal? Was there something about the one property that didn't show up, or what was it?
Yeah, and I mean, in the case that I'm thinking of, it really is the fact that it's on a busy road, and all of the comps they were from a block over, houses that had just sold that weren't as big, that weren't as nice on the inside. And so they look like they're good comps, and the appraisal just doesn't take into account, hey, it's on a busy road, let's dock this $20,000. It just doesn't. They'll dock it for not having as many rooms or not being as new or whatever, but they're not taking into account the fact that we had one house that we found out after we funded it was across the road from a recycling facility. That one was really hard to sell.
Yeah, yeah.
It's like, this is why it's nice to be able to travel to your house, or even getting BPOs as well as appraisals, so that the realtor can say, hey, do you know this thing
Yeah.
located in such and such a place?
We really like doing that as well. The BPO being a broker price opinion.
Yes.
And the difference being that an appraisal is done based on comps of previous sales, whereas a BPO is done based on that, on the broker's opinion of that, and also what the potential is in the future based on the way things are selling, based on the demand for certain properties, based on, like you said, maybe based on certain functional aspects of the property.
Right. And the broker doing your broker price opinion cannot be involved in the transaction where your borrower is buying that house, because
Absolutely,
they want to sell the house and make the money. So it's got to be a neutral third party. And basically what they're saying is that, hey, if you ask me to list this house, I think I could sell it for X dollars. And here's why. And they'll support it, why they think it's worth that.
Yeah.
So.
Yeah, and that's what we talk about this a lot on the show, and that is alignment of interest and making sure everybody's pulling in the same direction. And in the case of a broker that might not be quite as aligned, it may be where they come in and they give you a pie in the sky number because they would like to get the property listed. Once they have it listed, then they can start talking about getting it reduced or whatever. Not saying a lot of brokers do that, but I know that some of them do. And the best way to get around that is just to get disinterested third parties, or people that don't have an interest in the property at the time that the work, or even other contractors at the time that the work is being done on it. So that makes a big difference.
Right.
So creating that alignment of interest, and with the teams, creating teams so that everybody's always pulling in the same direction, that can be huge. Now, the properties that you were just referring to, roughly, just for context, what price range, generally speaking, were those?
So one of them appraised in the low 200s, like 225 or something like that. And so we lent 100, whatever it appraised for, I'm not doing my math well, but we ended up lending 170 on it. And we haven't been able to get an offer over like 150.
And again, it's because of the location.
Because of where it's at. Nobody wants it. Well, we've had trouble getting an offer. When we get the offers, it's an investor who's like, I'll buy it, but I'll give you this.
Yeah,
so,
right.
Yeah, we're still working on selling that one.
Okay. How about resources or things do you have any resources that you
do I have a minute to add one more thing that I've learned?
Sure, absolutely.
Okay, so we've talked a lot about the properties and the borrowers, but I know that you have people on here who are investing money with other people, and potentially who are taking money from investors to invest in their deals.
Right.
One of the things that I wish I'd learned earlier is how to, my underwriting criteria for the people investing with me. And as much as, like, if you're investing money, then you want to be able to know that the person you're putting money with is reliable and that they know what they're doing. When you're taking money from somebody, you need to know that that person is sophisticated enough to be investing with you.
Yes.
And that they're not going to get stressed out at the littlest hiccup, because things go wrong. Properties take too long to sell. Something comes up when you're rehabbing it. The market shifts. And if your investors are going to freak out when they don't get their money back the day the loan was expired, or the day you said that you'd be paying it back, you got to know that in advance, because that's harder to deal with than the problems that come up with the properties.
Yes, the pressure that puts. I know exactly what you're talking about, because especially early on, before we got involved and before we started the real estate funds that we have. And that absolutely, that is the case, that it can be just so time consuming and draining to be able to manage through some of those concerns.
Right.
And so any advice on how to select or how to make that happen, that we know that we're working, again, it's the alignment of interest. It's making sure everybody is on the same team, everybody's pulling together. And even in the case of somebody who's offering or investing money in the project, if they're pulling too much in an opposite direction, it makes it really hard and time consuming.
It's kind of counterintuitive when we go to get money from people. We want to paint a rosy picture of how great it's going to be and how much money they're going to make.
Mm-hmm.
But I would say that you should really try to scare them off.
Mm-hmm.
I mean, tell them the upside, of course, tell them the upside, but tell them all the downside as well. And this could go wrong and that could go wrong. And it could take an extra 2 years to get your money back.
Mm-hmm.
And see how they react to all of that. And if they're like, okay, yeah, I get it, that's how it works, then they're probably someone you could work with. But if they start to get really anxious, they're probably somebody who should put their money somewhere safer.
Yes.
Maybe.
Yes. Well, and we'll just go into that just a bit here too now. And that is when an investor is accepting money from another investor, there are definitely rules involved in that. Yes. There's SEC guidelines. There's the 3-touch rule within 45 days or 30 days, depending on which. It's not a written rule, but it's a guideline that the SEC attorneys we're told that it's sort of a guideline that if we stay within that, we should be relatively safe. And that is a 3-touch rule, meaning we need to have had business relationship of some sort, even if it's a communication, like a direct communication back and forth, at least 3 times within, and it all should have happened within a period of no less than either 30 or 45 days. And I say 30 or 45 because I've heard I've heard both, I guess I should say.
Yeah.
And so the other thing is accredited investors. And I think what you're alluding to is the more that if you're an active investor with a project, the more that you can aim towards an accredited investor, somebody who has $1 million net worth or higher, excluding their primary residence, or has $200,000 a year consistent income if they're single, or $300,000 if it's a couple, I think are the rough guidelines. But do your own research on this. I'm certainly not an attorney. Jessica, you're not an attorney.
No.
So full disclaimer here, do your own checking. The purpose of this discussion that we're having right on this topic right now, though, is to warn everyone that there are guidelines that have to be followed with the Securities Exchange Commission, because real estate is considered a security in certain circumstances. And so just really double check on that. Make sure you're not getting not getting in hot water for doing something you shouldn't be doing.
Right.
But the reason that the SEC has designated sort of made that designation of accredited versus non-accredited is that the accredited investors, they can withstand more of a, like, let's say there is a loss, or let's say there is the income stream stops for a while and then it picks up again. There's a lot better ability typically for that accredited investor to be able to understand that. Plus, it's generally speaking, they feel that, let me put it this way, the interpretation is that accredited investors typically have more education around the type of investing that they're doing.
Right.
So.
Right. Because at minimum, if they have $2 million to their name, they've had to figure out how to invest that $2 million to get a return. So they're going to be more experienced than somebody who has $50,000 to their name.
Yeah.
The person with $50,000 might want to invest it and make a good return, but they aren't really ready for any hiccups that might come either.
Yeah.
And that isn't to say, Tom, that every accredited investor is going to take all those waves smoothly.
Yeah,
because
exactly.
they get anxious too, but at least they have a context for you to come back to them and say, yeah, but you did these kind of deals before. Did yours ever go perfectly? No, Of course not. So
right.
You don't need to worry. This will work out.
Yeah. And just to wrap this portion of this up would be to say that as investors, an investor has money there, they can invest however they want to invest. It's the fact that the active investor, the person that's looking for the cash, has to be really careful on how they approach someone or approach or what their efforts are towards raising capital. I think that's what I want to get across, is just being really careful not to go out and post something on Facebook that you're looking for cash because you've got a great investment. I mean, absolutely be careful on that, because that's that would be a complete no-no to be doing that. So, did that cover?
Yeah.
That?
Although, I mean, that said, because if you have rehabbers listening to this call, of course, if you own the real estate, you can go raise a loan from whoever you want, but you can't raise equity money. So without actually following the SEC guidelines. So.
Gotcha. Okay. Well, good. Let's see. You mentioned a checklist before. You have a checklist that you work off of?
I do. Yes.
Is that something that you would be open to sharing?
Sure. Sure.
I
can share it's my lender's checklist for loans against single family rehab properties. Okay. So I can share that.
Okay. Excellent. That'd be great. And if somebody would like to get a copy of that, how would they reach you? What's your contact information?
Okay. Well, my email address is Jessica, Jessica, at goodsteward, STEWARD, capital.com.
Okay.
So Jessica at goodstewardcapital.com.
Cool. And for anybody who's driving, we'll have that in the show notes. Don't get in an accident while you're trying to write this down. So it will be in the show notes. And let's see, do you have any learning resources that you can think of that you used or that you recommend for anybody, whether they're passive and looking to put money into a deal or a fund, or if they're active and they're looking to move forward on their deals? Anything come to mind?
You told me at the beginning you were going to ask me this too. So, there's nothing specific that comes to mind. Like, there isn't one particular book. I do recommend George Anton's books, Private Money Code.
Yep.
There's definitely really good information in there. And otherwise, like, if you're looking to build your criteria, your underwriting criteria, I would recommend going to a RIA or something like that, a real estate investment association, and finding the people who are doing it now. So, like, if you went to lend, for example, you're not necessarily going to talk to other lenders. You're going to talk to the rehabbers or whoever your potential borrower might be, and just start asking them what could go wrong, what things have gone wrong, and use that to make your underwriting criteria of, okay, well, I don't want to lend on a house that's on a busy road then, because it might not.
Right.
And that's really probably where I've gotten my best tips, is from people who are in the trenches doing the dirty work, who will tell me all the things that could go wrong, so that I can then make sure I avoid those things.
Yes. Good. Yeah. So that's great. And I will make sure that the show notes show your contact information. One thing I want to just say for any listeners out there, I'd really like to get any sort of feedback. We want to make sure that this podcast is as close to exactly what everybody wants as possible. So any comments on what you like about the show, what you think could be improved, anything like that would be absolutely very much appreciated. If you have a chance, you can go on iTunes or SoundCloud or Stitcher, and you can subscribe to the show. We'd love to get comments and reviews about the show. I think you can even rate the show. So, or if you go to tombraegelmann.com, you can leave comments there. And again, we really want to make sure that we're hitting the target and giving value to people. So, any parting thoughts, any parting words, Jessica?
No, nothing comes to mind, but thank you so much for having me on your show.
Yeah, you bet. And thank you for being on the show. And when Judah wakes up, say hi to him for me.
Okay, thanks so much.